Mark asks, can you, without just repeating the talking points, explain how your IBC with a whole life, properly structured, specially engineered, of course, policy compares with my own savings account? Sure, Mark. It's better. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's installation in our Q&A series, I'm going to be addressing some questions that I've received from the wide webs, from my daily interactions, being on the phone with prospects and clients. So I look forward to addressing questions and comments about infinite banking, whole life policies, all things IBC. Let's get started. Jordan asks, should we get the policy on my spouse since they earn more in income? This is a great question. I get this often enough. Maybe, maybe not. It just depends. There are lots of variables. So when you're getting a whole life policy for the purpose of implementing infinite banking, it does behoove you to ask lots of questions like, who do we need to have protection on if we don't have protection on somebody? That's not a bad place to start. Everybody should have adequate protection, adequate death benefit. I personally can't have too much death benefit. For my own taste, for my own likes, I can't have too much, okay? And I don't think that you can either. You're the most valuable asset. It's not your car, it's not your home, it's not your business. You are. You are. And if you have those that you care about, then for sure you should be adequately, as much as possible, as much as you can wrap your mind around, as much as you can get, protected. Okay? So there's always that, in my opinion. And there are plenty of folks that don't necessarily cover protection as much as I think protection merits. Whole life insurance as an asset is invaluable when it comes to having guaranteed protection. Yes, we're going to have it properly structured for the financing of the things that we're doing in a household business or are investing, for sure. But they come with a death benefit, and it should be an adequate one, and that should be structured based off of your individual needs. So I wanted to preface with that. Now, should the highest income earner then inherently be the one that gets the first IBC policy? Not necessarily. Maybe, maybe not. And Jordan and I had a discussion, but of course I'm sharing this with everyone who's vetting this concept, so you can just be speeding up your learning curve on what you should be considering. So should the highest income earner? Possibly. There's a case that could be made that, well, that person for sure should be insured adequately, but I think that everybody should be insured adequately, so there's always that also. And this is where a convertible term policy with a good mutual life insurance company can come into play, because you could be getting an IBC policy started on someone and get more insurance, get more death benefit with a convertible term policy, even on that person. Okay, so you're putting a lot of premium, a significant amount of premium for you into the whole life policy, and then you also get a term policy to go along with that, so that you get both the high cash value policy plus the death benefit amount that you want. And then, of course, you could always walk that out and do that with the spouse as well. Get a term policy, or go ahead and get a whole life insurance policy as well. You know, my particular trajectory, which is not cookie cutter for everyone else's, we did start with me. I'm the male in the house. There's something to that. You know, it's just statistically speaking, actuarially speaking, it made sense for me to get coverage right away, for sure. Wife, 2 young kids at the time in 2015. That for sure made sense. But it wasn't 6-8 months later that we got a policy on a high cash value policy, an IBC style policy on my wife as well, because we caught on to this idea. So the answer is maybe, maybe not. Maybe you need policies on both. If you can make it possible for you both to get high cash value policies, great. If one of you needs to get a high cash value policy getting started, but the other one wants to lock in your insurability with a convertible term policy that could be converted later on to an IBC style policy, a whole life policy, great. You could do it that way, or a mixture of those, of course. So I hope that was helpful addressing who should the policy be on, even if one spouse is earning a higher income than the other. Demetrius asks, can I transfer my 401k into my policy without a penalty? That's question one. We've actually got a second question. So the answer is no, there's not a direct rollover from a qualified plan, a government qualified plan, to a private contract, a life insurance policy. There's not a direct rollover, so to speak, like you see in government qualified plans. However, there are folks that choose to follow different routes. So some folks will decide to keep qualified plans and keep contributing and get a policy. That's one way. They learn about IBC, but they already had these 401ks or IRAs or what have you, and they just do both. There are some who have 401ks, IRAs, whatever the case may be, learn about banking, get a banking style policy, and they divert funds that had been going to qualified plans and they put that towards a policy instead. So they still keep those plans, but they don't further contribute to those plans. Then there are folks that find out about infinite banking. They get a policy for themselves or a system of policies, and not only do they not keep the qualified plans or quit contributing, but they absorb penalties and fees such as they are. And right here, I'm not giving advice. I'm just telling you possibilities. I'm just sharing what I talk with folks about, and folks land in different avenues on this. They have a different stance, and I'm just here to encourage you to be your own banker in whatever it is that you're going to do. So those are some routes that folks chose. I know what I chose for myself when I learned about this concept and had a 401k and a state retirement and things like that from having worked in the state of North Carolina as a law enforcement officer and as a teacher. But everybody's different and they'll choose a different route. The answer simply is no, there's not a direct rollover. And then there was a second question from Demetrius. How often can I borrow from my policy per year? Great question. Practical question. For the purposes of infinite banking, we need to remember that a policy is not like a checking account. It's not like you're swiping your debit card. So number one, you probably don't want to be on the phone every month with the insurance company anyway. They're not designed to be on the phone every month with you, every week with you. But essentially, when you have a cash value in your policy, you can borrow against it. Now, I think that for most situations, it certainly makes sense that once, twice, maybe once every quarter, that you can make a policy loan to be paying off debt. Because let's say you're paying monthly premiums. Well, it would probably behoove you to let those premiums build up a cash value, create a cash value over 3 months, 4 months, 6 months, then take a policy loan to pay off that debt, recapture interest, recapture principal that had been going to those debts, keep snowballing your debt, wait another 3, 4, 6 months or so, take out another lump sum, throw that at the next debts, and work your snowball in that way. But anything more often than quarterly, it would just be cumbersome for you. It'd be cumbersome for the policy. But essentially, when you have a cash value, you can make a policy loan, and you can make as many policy loans as you wish while you have cash value to be able to leverage. But prudently, reasonably, it would make sense probably to do something quarterly, twice a year, once a year for bigger things. It just depends on how you're using your policy. So I hope that's helpful for everyone else listening. Lyric asks, can I put the death benefit in a trust? I get lots of trust questions, so thanks for that question, Lyric. I'm going to address it here for everyone. So a trust can own the policy. A trust can be the owner of a policy. You could designate, if you privately own the policy, you could designate a trust to be the beneficiary of your policy. So both of those are possible. Now, what I would encourage everyone to do is to privately own this asset. Even if you do decide to transfer the ownership or to designate the beneficiary as this trust that you have. You can always make the trust a contingent beneficiary, a contingent owner. But here's what I'm saying. A life insurance policy that's been structured for the purpose of infinite banking with a mutual insurance company that pays a dividend, it's a private asset. It's very simple. It's the most simple thing for you to be able to own this self-collateralizing, compounding, appreciating asset and have guaranteed contractual right to access capital for your own personal household, a business, your own investing. It's so very simple for you to be able to own it and operate it and use it. You pay premiums. You make policy loans when you want to make policy loans. You're an honest banker. You pay that back plus interest. You're growing. You're compounding this private asset. It's yours. You can do what you want with it. Now, be that as it may, it's simple to transfer that ownership later on if you do decide, again, to transfer the ownership to a trust. I know that wasn't the exact question here. The question was about the death benefit going to the trust. So the answer is yes. You can have your death benefit go to any individual, a church, a charity, trust that you choose for the death benefit to go to. And that will be a tax-free windfall to a trust or to an individual, to your family. So for folks that are thinking along the lines of trusts and private assets and windfalls and legacy, in my opinion, there's no more ideal asset for legacy purposes than a properly structured whole life policy with a mutual company that pays dividends. It will culminate in tax-free access to capital during your lifetime and then a tax-free transfer of wealth to your beneficiaries. Kristen asks, what makes my death benefit go down, or what would make my death benefit go down? She said her mother-in-law has a universal policy. So there we go. That's in the answer is in the question itself. So when I had this conversation, we were talking about a policy, I believe it was from the 80s, maybe the 90s. And that's where I feel for folks when I get on the phone with them and they have a universal policy and maybe they didn't pay the types of premiums that was necessary to be able to try and keep this thing afloat long enough. And especially if somebody had universal life products and then now they've experienced some type of health scare or even a very real health issue where they perhaps would not even be insurable now. If they'd had a whole life insurance policy, any change in their health wouldn't change that policy. They would already have it for their whole life. So that's always a difficult conversation to have with somebody when they're saying, well, my mother-in-law has this policy and the cash value is going down. What's happening? So with universal products, there's risk. It was touted that there would be flexibility when it came to premiums for the standard universal life insurance. But knowing human nature the way that we do, if we've read Becoming Your Own Banker by R. Nelson Nash, we have a tendency to not address Parkinson's law the way that we should, meaning that we tend to spend all that we earn. We take up all the time that it's allotted to us to perform any given task, whether we needed that full amount of time or not. Okay, so folks just didn't necessarily fully fund their policies, and then they get to the later years in life, and the premiums have to be paid to keep any policy in force. And it's the cash value then that begins to pay for that premium, so this policy begins to self-cannibalize. Of course, nowadays we have index universal life insurance, and there are others. There's variable universal life. So all of these insurances, universal life insurances, they're touted as permanent life insurance, but they are not equal to whole life insurance that has level premiums, that it doesn't matter if you have some type of health change later on. This whole life policy is going to be with you your whole life. You pay that set premium. That premium amount's never going to go up. Like with a universal, if you need to pay more premiums to be able to keep it afloat, to be able to account for that rising cost of insurance with a universal product, if that doesn't come out of your cash flow, meaning if you don't pay for that when you get to your 60s and 70s and 80s, when you would most want, when it's most likely that you will have that policy payout to beneficiaries, is when it's most likely to lapse, when it's most likely to self-cannibalize. So if you don't pay those premiums out of your cash flows because you can't, or it just becomes prohibitive, that policy will eat the cash value to be able to provide its policy premiums for as long as possible until there is none and it lapses. And there you are with something you thought was permanent life insurance. And not only do you not have it for what you perhaps thought it was going to be, some retirement, some investment grade, that's other folks' language, not mine, investment grade life insurance, not only do you not have that, but you don't have a death benefit that you render to your beneficiaries. It's very sad. It's very hard to deal with, but that's the answer, is that universal life policies can self-cannibalize. They eat their own cash value to pay for the ongoing premiums. Now, the next question that I had from Kristen, these were good questions, was what makes my cash value go down? So one thing, of course, that would make a cash value in a whole life insurance policy go down is if you take a policy loan, which of course we encourage. We encourage you to finance the things privately that you would otherwise do in life, to be the banker, of course, and be an honest banker. So if you take a policy loan against your cash values, then that's going to make the cash value go down. What's something else that can make the cash value go down? If you're in your passive income years in life and you've strategically been accumulating capital in your whole life policy for the purposes of supplemental income, well, you could certainly get to a point to where the policy's gotten efficient enough that its growth year over year is more than enough to pay its own premiums and provide growth. So you could see, though, a change in the amount of cash value from one day to another if it's paying its own premiums moving forward. But of course, again, if you've been using a policy for the infinite banking purpose, then from the start, it's going to be even better than how it originally illustrated. That's something important to know. How you use a policy is more important and beyond what you can see in black and white from an original illustration. So I would encourage you, if you have a current policy, make sure to get updated illustrations annually from your insurance company so that you can see your current numbers. That's very helpful. But there are some things that can make cash value in a whole life insurance policy go down. Taking policy loans, paying premiums out of the cash values of your policy because perhaps you're in retirement age years or you're in passive income years and you're just letting the policy pay for itself, and perhaps even accessing cash value to supplement your income. So there are different ways that cash value would go down. But in and of itself, when you pay premiums into a policy and you own that policy for your whole life, the death benefit never diminishes, barring any policy loans that you take, because that's essentially accessing part of the death benefit now, in the here and now. But the cash value, the death benefit, both, they can go up. Not going to diminish, and they can go up. I say they can go up because dividends, they're not guaranteed. But if you have a policy with an insurance company that's paid dividends consecutively for over 100 years, that's a highly respectable anticipation that you have of a dividend, even if it's not guaranteed. But there's also guaranteed growth in a policy. So all that to say, death benefit goes up in and of itself for the policy. Cash value goes up because the cash value must eventually equal the death benefit. And that's not even accounting if you use the policy for infinite banking. If you use the policy for infinite banking and you pay additional premiums because you've accounted for the banking function in your life and you're recapturing interest that otherwise would go somewhere else and you're funding that into your private banking policy, the numbers go up. So great questions, Kristen. I appreciate that. Marcus asks, when I take a policy loan, am I borrowing against the death benefit? Great question. I've actually heard this a few times here recently, just this week. No. The answer is no. When you take a policy loan, You are not taking a policy loan from the death benefit. When you pay a policy premium into a whole life policy that's been properly structured with a mutual company that pays dividend for the purpose of infinite banking, it creates a death benefit, guaranteed. Also, that death benefit creates a cash value, because if they're promising you a greater number, the insurance company, a greater number in life, they anticipate that it'll be a good while before you receive that, or your beneficiaries receive that. Of course, you're not going to receive it, but it creates a cash value, a surrender value, because they're contractually bound to pay that future death benefit. And if at any point along the way you want to quit, take your ball and go home, then they're going to say, well, here's the surrender value. This is a private asset. It has a cash value. It has a surrender value. So when you take a policy loan, you're collateralizing, you're leveraging the cash value, not the death benefit. That's for your beneficiaries. You are leveraging and collateralizing the cash value. So policy loans are taken against the collateralized, the leveraged cash value. Now, the cash value must eventually equal that future death benefit, so the cash value continues to rise, but folks are not taking policy loans against or from the death benefit. Now, if you have an outstanding loan at the time of your passing, then the insurance company will simply deduct the policy loan that you've already taken from the death benefit amount, because you've already accessed whatever that policy loan amount or any interest was, and they'll still pay the death benefit tax-free to your beneficiaries. So policy loans are not, N-O-T, not taken from or against the death benefit. Now, this last question comes from our YouTube channel, where that can be wild. And normally if there's profanity used, I won't publish that. I won't let those comments come through. But if we can be civil, even if we're on opposite sides of the table, so to speak, I don't mind those comments or questions being published on the channel, because I believe that the discourse, the conversation is valuable. My belief is that when you see the light, darkness flees from it. Okay? When you learn something, you can't unlearn it. When you're exposed, when it dawns upon you that you can control the banking function in your life, I don't care what anybody else says to the contrary. Okay, I use this analogy sometimes. If I've watched folks like I did as a young kid ride bikes, having fun, laughing, doing tricks, popping wheelies, and I get interested in that, and I've watched enough, and I get on the bike for my first time, and I take off, and I enjoy that for my own self, and I experience that for my own self, you can't tell me nothing. Okay, you can't tell me that riding a bike doesn't work or it's not fun. Okay, and I know it's like, even in my own mind, there's a part of me saying, well, yeah, Jesse, but you fell a couple of times with the bike trying to learn that probably, right? And that doesn't happen with a policy. I mean, if you pay premiums into a whole life policy, you're going to get a guaranteed death benefit, period. And if it's been properly structured for the infinite banking concept, you can use it for the banking purposes in your life. Okay, so no crashes, no failures there. But I'm just telling you how I think about these types of things. Well, we've got a comment from Mark. Mark says, can you, without just repeating the talking points, explain how your IBC with a whole life policy, properly structured, specially engineered, of course, etc., compares with my own savings account? So I'll probably put up a screenshot here of this comment. I went back and forth with Mark for a little bit, getting the feeling that I don't think he's actually open to my response. Maybe you'd call it combative, maybe you wouldn't, but it was respectful enough that I felt like continuing for a while, to a point. And the point for me is this: the arrival syndrome. When a Dave Ramsey or a Mark or anyone expresses to me an unwillingness to learn, here's where all those sayings come to my mind, and maybe yours as well. You can lead a horse to water, can't make it drink. I've got a buddy who says you can't push a dead bear up a tree. Okay, Jesus said, don't cast your pearls before swine. So I'm just saying, if someone's not open to learning, I can't help you for sure. For sure. So I'll try and be more conservative with my time. But what I did try to provide to Mark was more than a dozen reasons of why I simply think that and I'm not even talking about infinite banking yet. I'm just talking about the product. See, there is a product, there is a process, and there are principles and a philosophy. Okay, so I'm giving you 4 P's right here. The product is whole life insurance, properly structured with a mutual company that pays dividends. I'm going to talk about that with you and with Mark to address this question. The process is banking. Banking just exists. I didn't invent banking. It's just that way it exists. Okay. I also didn't invent whole life. Going back to that, whole life has been around for hundreds of years. Okay. I just use it and own it and love it as the ideal asset, the ideal product. Okay. So the product, the process, there are principles. I've learned some principles from R. Nelson Nash. Think long range. Don't be afraid to capitalize. Be an honest banker. Don't do business with banks and rethink your thinking. That one's really important for this conversation, I believe. And then there's the philosophy. The philosophy that you could become your own banker, that you could do that for yourself. You have to account for these human problems like Parkinson's law, Willie Sutton's law, the arrival syndrome. Okay. The idea that, I already know that. I'm already doing that. I'm a 10. I'm at 100%. I can't do any better. I know it all. Okay. So those are the things that are coming to my mind when I address something like this. So when it came to product, sure, I said there are absolutely more than a dozen reasons on why I think that a properly structured whole life policy with a mutual company that pays dividends is the ideal financial asset. Period. Bar none. And I'll put those up here. Okay. More than a dozen reasons why that product is the ideal financial asset. Okay. To be compared with a savings account at a bank. There's so much there. Number one, okay, if I go to the process of banking next and not just talk product, banking is a business. Banking is a business. The banks that are in your town, Mark's town, my town, someone owns them and someone profits from them. When we warehouse our capital there in someone else's business, it's profitable to them. They profit from it. They're loaning out multiples of our dollars for their own profits. Okay. I'm saying that we could enjoy the profitability of being our own banker. So suffice it to say, I'll share some screenshots here of the conversation. You let me know. How did I do? Was I respectful? Am I being respectful now? I hope so. I really don't think that Mark was very open at the time. Hopefully he'll become open. Maybe he'll even watch this information and see me face to face, feel my sincerity that, I did everything that I was conventionally told to do. Got a 4-year degree. Worked as a law enforcement officer and a teacher in the state of North Carolina, contributed to my 401k, did things with the banks, tried to make smart financial decisions, and thank the good Lord, I was open-minded enough when I got a phone call from a friend saying, hey, I think you should check out this live presentation in South Carolina about becoming your own banker. And there's actually a book about it too. So I went to the presentation. I read that book, Becoming Your Own Banker by R. Nelson Nash. And it was it for me. I just saw a way for me to be able to control and profit from the banking in my life and decided to learn about it, ask questions, and implement it. So I hope that this has been helpful for me to address questions and comments. If you have any questions or comments, feel free to put those in the comments section or to have a conversation with me. You can find my calendar link on our website, DurhamTalents.com. But this has been a great pleasure for me. I look forward to our next conversation. Have a great day. Take care.